Learn on the go and stay informed. Our goal is to keep the average user informed and up to date with relevant tax information. For the entrepreneur and investor, getting acquainted with tax laws and regulations could be quite daunting. Well, not anymore. Introducing the KPMG Tax mobile app, where you can access all tax related news, laws, and insights in one place. Also, calculating personal income taxes has never been quicker. To get the app, simply search for KPMG Nigeria Tax on Google Play Store or iOS Store and install. Once installed, quickly do a one-time sign up on the application to access a constantly updated library of news, laws, and articles alongside easy-to-use tools. The KPMG Tax mobile app has a minimalist design, making it effortless to use and navigate. What's more, if you can't find what you need, asking a professional is as fast as it gets. Let's walk you through the application. The full menu is accessible from the left and helps you jump to any part of the application in seconds. Access fresh tax news by clicking on the news icon. The seamless scroll makes it simple to view all news at a glance. You have news you've already seen and want to go back to? Just search. Expand or share each news item to your friends with the dedicated buttons. Adjust your news preference easily from the settings icon and tailor your content. We have embedded tax legislation and popular cases in our tax laws section. Are you eager to know more about taxation in Nigeria? KPMG Tax app has more than enough for you. Stay on the cutting edge of industry updates with insights features. The new app brings together alerts, newsletters, articles and publications from industry-leading KPMG professionals. You don't have to worry about missing important regulatory dates and other notable events. The notable date feature brings them all into one place in a calendar or list, however you want to view them. For the average employee, entrepreneur or business person, KPMG Tax app has another important feature, the PIT calculator. Plug and play, simple as it gets. Input the required numbers and calculate your taxes. Also, the app has jokes and valuable tips. Check in to learn something new and fun. Still feel there's more to know? We've got your back. Ask an expert and get quick, insightful responses from KPMG professionals when in doubt. Learn more from various authorities through recommended links in the external links tab. Read all about us to find out more about KPMG's service offerings our responsible tax principles and disclaimer. It's now a breeze to connect with us online. Just click on the link icon on the homepage to get to us on social media. KPMG Talks App, connecting with you on the go.
Okay, good morning, everyone, and welcome to the November edition of the KPMG Nigeria Tax Chat. My name is Omojo Okwa, and I'm the manager with the KPMG Nigeria Tax Regulatory and People Services Division with a focus on transfer pricing. And with me today is my colleague, Gali Aka, a senior manager with the transfer pricing unit of the Tax Regulatory and People Services Division. And we'll both be talking about what I believe would be a very insightful topic titled Navigating the Controversial Landscape of Transfer Pricing Audits in Nigeria. So our actual objective today is to make sure that this session is as interactive as possible, and you, the participants, are able to share your views and have your questions addressed. So I'd encourage all of you to take advantage of the chat box. Drop your questions, feel free to chat with us. We would try as much as possible to fully address any questions that you have. And we'll also be having a poll with two polls actually. So one just after the introduction by Gali and the other at around 11 o'clock. We encourage you all to be as actively involved in this session as possible in order to draw maximum benefit from the session. So at this point, I'll hand over to my colleague, Gali Aka, to give us the introduction. Over to you, Gali.
Thank you very much, Omojo, for the wonderful introduction. My name is Gali Aka. I'm a senior manager in the transfer pricing practice of KPMG in Nigeria. As a background, the first set of transfer pricing rules were introduced in 2012, defining the compliance requirements for taxpayers in Nigeria. The 2018 updates incorporated the base erosion and profit shifting Action 13 recommendations, and also included stiff administrative penalties for non-compliance. So one of the notable updates in the 2018 regulations was the clarity on the types of documents required to support the arm's length nature of related party transactions. So that gave the FIS an edge in terms of conducting the risk assessment procedure prior to selecting a taxpayer for transfer pricing audits. So TP audits has surged significantly since 2019. And this is largely due to the FIS increased effort towards generating tax revenue in the face of the dwindling oil revenue. The FIS has also shown a strong drive to enforcing compliance with the regulations through this audit process, as well as the imposition of the FT penalties as introduced in the 2018 regulation. So apart from the need to prepare TP documentation and filing of TP returns, it is also essential that taxpayers are aware of the risk areas prior to being selected for audits. And one of the things that we've seen in practice is that although a taxpayer may have filed transfer pricing returns, the taxpayer may have prepared a robust transfer pricing documentation. However, the FIS are still able to make substantial adjustments to the transaction in terms of the pricing. The FIS are still able to impose penalties for inappropriate disclosure. So we'll be talking about that in sufficient details as the event goes on. And one of the key triggers for transfer pricing audits in Nigeria is the category of transactions that are being conducted. For example, does a Nigerian entity enter into contract for procurement arrangements? Do you pay royalties for use of intangible assets? Number two, the FIS will also look at the characterization and the approach to demonstrating the arm's length nature of those transactions. So those are the audit triggers from the perspective of the FRS. So we'll delve into that in sufficient details as we go along with the session. Thank you. Back to you, Omojo.
All right, thanks a lot for that very interesting introduction. I'm sure that from the introduction, a lot of you have it's already clear to everyone that there's a lot to unpack during this session. So we'll delve into everything in greater detail during the subsequent phases of the segments of this session. So keep your hands close to your keyboards. I'm sure that you'd have a lot of questions to ask us around transfer pricing audits, around the stiff penalties Gali mentioned. He talked about the risk areas. We're going to talk about all of that in greater detail. So just keep your hands close to your keyboards and type out your questions as they come. So before we go into answering the questions for the day, we also want to feel your pulse. I'm sure a lot of you already have some idea of this topic and probably even have experience with the TP audits already. So we want to feel your pulse, understand, what you're thinking about this topic. And so we'll be administering our first poll right now. I believe that on the screen, you'd see the barcode, which you can scan to join in the session, right? So you can just take your phone, put on your camera, scan the barcode in order to join the session. It should take you, you'd see a link which you can click to join the session. Alternatively, you can enter in the address that's shown on the screen. So I guess that's https://app.slido.event. So that's entire address. You could type it into your address bar, into your browser, and enter the code #97724. I'm sure someone has also dropped a link to the session, to the poll session in the chat box. So you can also just click on the link to join. So we'll just give a minute or so for a few of you to join on the poll, or rather all of you to join on the poll so that we can get as many responses as possible before we go into interpreting your results. So please feel free to scan this and join the session. If you're having any challenges connecting with this polling session, please just let us know. You could drop a message in the chat box and we'll see how we can help. But I believe it's very straightforward. Once you scan the barcode, you should be able to join in the session. All right, so we have a few people. We're waiting for a few more people. Okay, yeah, we've also started seeing answers coming in for the first question. The question is, are you familiar with transfer pricing regulations in Nigeria? Like Gali mentioned, they've been around for a while. So we can say a while now, since 2012, right? That's nearly 10 years. So are you aware, are you familiar with the transfer pricing regulations in Nigeria? Well, we're seeing a lot of confident answers. 63% of you are saying yes, you are familiar with the transfer pricing regulations in Nigeria. A handful of you somewhat, and a few of us are saying, no, I've never heard of it. Well, but that's the essence of this chat this morning, right? So before the end of the session, or by the end of the session, you should be able to confidently answer that you're familiar with the transfer pricing regulations and how it can impact your various organizations when it comes to audits. So we've gotten a handful of answers. The majority are still saying yes, they're familiar with it, which is a good thing, meaning we're probably going to have a lot of questions around the gray areas when it comes to the TP regulations and the audit process and how it impacts your organization. Around 40% are saying somewhat still, and around 2% of us are still indicating we've never heard of it. I think at this point we can move on to the next question, right? We already know the majority of us are aware of the transfer pricing regulations. So how well do you understand the focus of the TP audit? It's one thing to understand the theory or be aware of the theory of the regulations. It's another thing to understand the focus of the TP audit, because it's quite different from the regular tax audits, as the conversations we're going to have today would reveal. So I have basic knowledge. Okay, I have zero knowledge, very well. We have 24% being very confident of their knowledge of the focus of a TP audit. with around 54% of our participants indicating, that they would like to know more, right? So I guess all of us will be able to draw benefit from today's session and boost our knowledge. A few of us are indicating zero knowledge. That's probably because the audits have not come around to impacting your organization yet. So, but at the pace at which the audits are picking up these days, I really believe, very soon, most of us would have experienced the TP audits and would understand what it is. But before you delve into that, it would be important for you to be equipped with enough information. And that's why we're here today, to help you navigate the controversial area of TP audits. I guess we can go to the next question. 20%, very well, okay. Has your company undergone a TP risk assessment? So this is very crucial. Helps you to identify your risk areas when it comes to transfer pricing audits and the possibility of significant penalties crystallizing for your organization, and identifying ways to proactively plug any loopholes within your organization. So a few of us are saying no, we haven't. 63% rather, not a few of us, that's over half, are saying no, they have never undergone a TP risk assessment. This isn't too surprising to me. A few of us are saying yes, 23%. So, and some around the same number are saying they're not sure what a TP health check is. Okay, so before we are done with this session, those of us who aren't familiar with what a TP health check is would have the opportunity to know what a TP health check is. And for those of us who haven't undergone a health check yet, I guess you'd be encouraged to proactively undergo one, because that is very crucial to ensuring that the success of the audit, or rather the outcome of the audit, is it aligns with the organization's objectives. I think we have our fourth question. Can we have our fourth question now? Okay, do you have systems in place to ensure that your related party disclosures in your company's financial statements are complete and accurate? This is very important as well, because the stiff penalties Gali mentioned also covers incomplete and inaccurate disclosures of the related party transactions in your financials, in the returns that you're supposed to file annually, and in your compliance documentation. So this is very crucial. So 60% of us are saying, around 56% now are saying yes. This is encouraging. It means that a few of us would be able to avoid any penalties that could arise from incorrect disclosures. Some are saying no. It's very good that if you do not already have those processes in place, you begin to put them in place to avoid those significant penalties. And we also have, so we have a split, like around 50% of us are saying either not sure or no, and over 51%, around 51% of us are indicating that they have those processes in place to ensure that their related party disclosures are actually complete and accurate. So we have a 50-50 split roughly between those who actually have those processes, those who are not sure, and those who are indicating no. Okay, all right. So can we go to the next question here? So how would you rate your company's record keeping on related party transactions? This is also a very important area, and it helps significantly if you have those record keeping processes on lockdown to ensure that you're able to control as much as possible the outcome of an audit. So we have around 55% saying that they're confident they have good record keeping processes in place. Some are saying excellent, which is fantastic, right? Have fantastic, wonderful record keeping processes in place, and you're highly confident of what you have available already. And then there's, for a few of us, there's room for improvement. We are aware that it's not good. So that's why we're here to help you, right? So if you need any assistance with making sure that you have the right records to defend the arm's length nature of your related party transactions, we can always assist with that. So yeah, so 54%, so roughly 80% of us, over 80%, either have good or excellent record keeping processes in place. And for around 16% of our participants, there's room for improvement. Okay. So that's interesting to see, right, Gali? What do you think of the results of our poll so far? Does it come as a surprise to you, or is this what you were expecting to see based on your interactions with your clients and the public in general?
Yeah, it's actually what I expect to see, because based on our interaction with clients that we support for audit process, these are the kind of responses that we get when we have pre-audit engagement meetings to try to assess their level of compliance with the transfer pricing regulation in terms of filing TP returns and preparing TP documentation. Then in terms of having appropriate records in place to support the arm's length nature of those related party transactions, though it's not perfect, but we realized that a good number of companies have appreciable records in place to support each of the transactions being conducted. So the results of the poll is not surprising.
Yeah, so same here, I agree with that. Well, but clearly for a few of us, there's still room for improvement. And I guess, that's why we're here. So throughout the course of this chat, we'll be talking about the importance, what records you need to have in place, and covering, the general tips on how to manage the process and make sure that your organization is ready for any TP audits. All right, so we can delve into our first question now. We had a few people indicating that they don't have any knowledge of the TP regulations at all. So rather than just start talking in general around the audits, I think the first thing would be to understand what is even the objective of transfer pricing in Nigeria. Transfer pricing is relatively new compared to the other categories of taxes that I'm sure a lot of our audience will be more familiar with. So, Gali, what is the objective of transfer pricing in Nigeria?
Okay, thanks so much for the question. The TP, transfer pricing, as we know it, it's an aspect of trying to assess a taxpayer to companies' income tax or petroleum profit tax, as the case may be, or capital gains tax. It's one of the processes that the tax authorities typically carries out to ensure that a taxpayer is paying an appropriate amount of tax. So it's not a separate tax on its own. It's just a kind of subset to the regular approach to assessing a taxpayer to tax. So TP focuses on the impact of related party transactions on the profitability of companies that are residents for tax purposes in Nigeria. As we all know, we have a lot of companies that have operations outside Nigeria, maybe in tax havens. And to ensure that there are tax savings at the group level, there is multinational enterprises, for example, have the ability to, plan around the amount of revenue they disclose in each of the jurisdictions they have operation. And the objective really is to ensure a favorable tax position at the group level. So there are instances where it distorts the allocation of taxing rights amongst jurisdictions, which is why the FRS released the first set of TP regulations in 2012 and also updated that regulation in 2018 to keep up with what's happening globally in the TP space. So the objective really of the FRS is to protect the tax base in Nigeria to ensure that multinational entities are not using related party transaction as a means to shifting profits from Nigeria, which has a higher tax rate of 30% to a lower tax jurisdiction. So that's really the crux of having TP regulations in place to protect the tax base in Nigeria, to ensure that entities pay appropriate taxes on the income that they generate.
Okay, that's very clear. And I guess that also addresses the reason why we are having an increase in the number of transfer pricing audits in recent times, with the government trying to, through taxes, generate higher revenues. It's only natural that they would scrutinize every aspect of taxation, including transfer pricing, right? Because the objective, like you said, is to make sure that the tax base of Nigeria is not eroded through transfer mispricing, right? Which multinationals tend to be able to take advantage of a lot when it comes to pricing their related party transactions. So thanks a lot for that response. The next is, okay, so the topic is actually transfer pricing audits, navigating the controversial area of transfer pricing audits in Nigeria. So what exactly is a transfer pricing audit, and what is its main focus? I think one of the things that you'd like to highlight, our participants would like to know, is what's the difference between a TP audit and a tax audit? So
generally, audit is an examination by an interested party to ensure that a particular thing has been done in an appropriate manner, or to ensure that unintended errors have not been, committed in the course of, putting together maybe your financial statements, or in the case of transfer pricing, you've not committed errors in pricing your related party transaction. So TP audit in particular focuses on the arm's length nature of related party transactions. If you go to the TP regulation 6, for example, speaks to existence. So the FIS wants to be sure that in the first instance, the transaction actually exists. So a taxpayer would need sufficient support document to prove that they received services or support services from a related entity. For example, if it has to do with technical services, so did the expatriates, did they come into the country? What's the evidence that they come into the country? So you see FIS requesting for documents such as the passports of the expatriates, such as the reports that they issued. So that's the first step. Then the next step is benefit test. So are you receiving, is the service of economic benefits to you, or you're just paying out money for services you don't require? Then the third step is commercial rationality. So is it reasonable for you to engage someone abroad when you can get the expertise locally at a cheaper price? So TP audit is, apart from looking at the existence of the transaction, apart from confirming that the transaction is of benefit to the local company, the FIS will also be interested in knowing that is the arrangement, is it reasonable? Would a third party be interested in entering into such arrangements? The last bit is to then test the arm's length nature of those transactions. So like I mentioned earlier, the objectives of transfer pricing is to ensure that the profitability of a Nigerian entity is not impacted by conduct of related party transaction. So as opposed to a regular TP audit, the focus of transfer pricing audit is on economic analysis. After a company may have satisfied the existing test, benefit test, commercial rationality, the last bit is then the arm's length nature. So have you conducted the transaction at arm's length? So that's the major difference, as opposed to vouching, as opposed to vouching like we have in the regular audits.
Oh, okay. So pretty much a transfer pricing audit focuses on the related party transactions, which is a relatively narrow area, but then it's able to scrutinize that aspect in a lot more detail, asking key questions to be able to establish that, the transactions actually did take place. And if they took place, the entity paying for those transactions actually drew benefit from those services, that there's commercial rationality, and it's priced in accordance with the arm's length principle. So those are the things that the tax authorities would be looking out for when it comes to transfer pricing audits, with their ultimate focus being the related party transactions of a particular company, of a taxpayer. So that's quite interesting to note. And in reviewing all of this, so what does the TP audit process from end to end look like? So how does it start? What's the end goal at the end of the day? So can you walk us through the process of the TP audit?
Thanks so much, John. So when you talk about TP audit, it starts from the risk assessment procedure that the FRS typically carries out in their office. So you can call it debt review. So after a company must have filed the transfer pricing returns comprising of the TP declaration and disclosure form, the income tax computations and the capital allowances, as well as self-assessment forms for payment of CIT and TET. So the FIS would review the forms, look at the nature of the transactions that have been disclosed. They will also review the financial statements. So after that is done, the FIS can then decide to select a particular client or taxpayer for audit. And one of the audit triggers is, number one, the nature of the transaction. So based on our experience, we realize that if a local entity has an intangible transaction with a foreign counterpart or is involved in the procurement arrangements, the FIS would typically select such local company for audit. Another audit trigger is the methods that have been selected in, analyzing the related party transactions disclosed in the TP form. So once the FIS concludes the risk assessment process and they've decided to proceed with the audits, the next step is to issue a letter notifying the company of audits. They would issue information and document request letter. And in the information and document request letter, they would typically request for intercompany ledgers. So, all records that relates to each of the related party transactions. The FIS will also request for agreements. They will also request for the transfer pricing documentation. Now, I know at the beginning I said the 2018, one of the major updates to the 2018 is the clarity on the types of support documents you need to support specific transactions. So if you look at commodity transactions, if you're engaged in, if you sell crude oil to a related party, there are specific, there are specific documentation that you need to have in place to support the ancillary nature of related party transaction. If you also engage in procurement arrangements, there are also a list of documents that the taxpayer would need to keep and present to the FRS in the course of the transfer pricing audit. So those are the kind of documents that you would typically have in the information and documents request. Then the next phase is the technical presentation. So the FRS would invite principal officers of the company under audit to come and make a technical presentation. So the expectation is that the company is going to present about its structure, its global business operation, and also speak to the accounting system. How are your records being kept? The company is also going to touch base on each of the related party transactions and the pricing arrangement. Although this would have been adequately documented in the TP report. However, the FIS will also like to listen to the officers of the company to speak to the company structure and the operations in general. Then the next phase will be the field audit phase, wherein the FIS is going to visit the premises of the company, and one of the activities is to conduct what we call a functional analysis interview. Now, in the course of preparing TP documentation, the TP consultant would have spoken to key process owners to understand their functions, the assets they utilize, and the risks they assume in relation to each of the related party transactions. So that would form the basis of, advising or demonstrating the arm's length nature of the pricing arrangements. So the FIS will typically repeat this process, and the objective is very simple, is to be sure that what has been documented, the TP report, is exactly what's happening live. So they will speak to the process owners. So once there is a deviation between what has been documented in the TP report and what the key process owners are saying, their responses they give to the questions being asked by the FIS, then that's the beginning of TP issues for the company. So the FIS are at liberty to then stick to a favorable response. So they might decide to stick with what the key process owners have said on field, or stick to what has been documented in the TP reports. And one of the key issues that we experience when FIS is conducting a functional analysis interview is the fact that the transactions or periods under review may be 2013, and the employees of the companies that were actually part of those transactions may have left. So the new guys do not understand what has transpired over the years, and the nature of the transactions may have changed. So one of the things we do to mitigate that is to prepare, the respondents ahead of the audit, to make them understand that you need to be clear to the tax authorities if you are now around as at the time those transactions were being conducted, and if there are changes, try to highlight what was and what is now. So moving on, the final stage will then be post-audit, where the FIS will issue reports on their findings. So the FIS will typically they will communicate a position based on their findings on the field, and the taxpayer is given an opportunity to respond to the FIS letter of intent. Then you follow it up with a maximum of 2 reconciliation meetings to resolve issues of dispute between the taxpayer and the tax authority. So the audit process could end there, or it could proceed to the TAT, and it could follow the normal tax appeal procedure for the regular tax audits. Thank you. Back to you, Omojo.
Okay, so from all of that, it is very clear that there is a lot to manage when it comes to the transfer pricing audit process. There are a lot of areas, where taxpayers need to be mindful of how the process flows, right? So we'll go into that, unpack all the different areas that you have spoken about subsequently. But the very first question I'd like to ask, you mentioned that a TP audit process would first start with a risk assessment, right? So the risk assessment procedure, what are the tax authorities really looking for beyond, say, maybe the existence of related party transactions? Is there a threshold for selection of companies for a TP audit, or is every company that has related party transactions at risk of being selected for a TP audit?
Okay, thanks. So ordinarily, you can't select all the companies that file TP returns for audits. So there are 2 main areas that the FIS typically looks at. Number 1 is the value of related party transactions. So they look at the threshold. And one of the notable updates to the 2018 regulations is the threshold of 300 million naira for it to maintain TP documentation. But that doesn't exclude or precludes that company from being selected for transfer pricing audits. And based on our experience, companies with transaction value less than 200 million naira are still selected for transfer pricing audit. So in that instance, it's the nature of the transaction that triggers the TP audit as opposed to the transaction threshold for such companies. So, and I think I mentioned it at the beginning that once you have intangible transaction, once you have procurement arrangements, loan, once you have procurement arrangements, then there is a likelihood that such company will be selected for transfer pricing audits.
Okay, so that's clear. There is, the tax authorities would not randomly, and clear and comforting, I believe. The tax authorities would not randomly just select any company and slate them for an audit. There are key risk parameters. So we as, or rather, would I say our audience as taxpayers preparing for the ATP audit are able to gauge and assess on what level of risk they carry, right? So if you have a significant number or value of related party transactions, you are likely to get selected for an audit. I believe the tax authorities would look at also whether or not, if you have high value transactions with your related parties, whether or not you're in a loss position perpetually relative to what they believe your industry should be making. They would also look at the complexity and the nature of your related party transactions. So if you have transactions such as procurement transactions, which they would, typically view as high risk, you're likely to get selected for an audit, etc. So the risk assessment process, I believe, would start with the tax authorities looking at the submissions made by taxpayers for annually. So they'll be looking at things like your transfer pricing returns, your country by country notification form, and your report if they're able to lay hands on that, as well as any other information about the company that's already available to them. So one of our participants is curious to know, so is the TP local file, your TP documentation, right, which we had talked about and which talks about your related party transactions, is it supposed to be submitted annually along with your TP returns? That's the first question. Over to you, Gali.
Okay, thanks so much, Joe. So the provisions of the law is that taxpayers that conduct related party transactions should prepare and submit transfer pricing returns. So the law only requires you to submit your TP returns 6 months after the year end in which those returns relate to. Regarding TP documentation or TP local file, as the case may be, taxpayers are not required to submit the TP local file along with TP returns. However, the tax authority, the FIS, may later request for the transfer pricing returns for the TP local file to be submitted, and the taxpayer would have 21 days upon such request to submit the TP local file. However, if the value of transaction is less than 300 million, the taxpayer would have up to 90 days to prepare and submit the TP local file to the tax authorities.
Okay, so that's quite clear. The local file, you do not submit.
Yes, that's clear.
Yeah, that's quite clear. So you submit the local file only upon request, and you have either 21 days or 90 days, depending on the value of your related party transactions, to submit this document to the tax authorities. Your transfer pricing returns are supposed to be filed 6 months after the end of your financial accounting year. But someone is asking, what about the country by country reports? At what point for 2021 financial year, for example, when is it due to be submitted, if it is supposed to be submitted at all?
Okay, for So for multinational enterprises that are headquartered in Nigeria, the country by country report is to be submitted 12 months after the end of the financial period it relates to. So unlike the notification is meant to be submitted on the last day of the accounting year end of the ultimate parent entity of the group. But the country by country report is 12 months after the end of the year it relates to. Now, if you're a member of a multinational enterprise group headquartered outside Nigeria, and the jurisdiction does not have exchange relationship with Nigeria, ordinarily the law requires you to make secondary filing in Nigeria, but that has been suspended by the FRS public notice issued earlier, sometimes this year or late last year. So as it is, only companies that are headquartered in Nigeria and meet the filing threshold are required to file country by country reporting 12 months after the end of the financial year it relates to.
Okay, so that's good to note. Companies do not have to, taxpayers in Nigeria do not have to file the country by country report locally at all, regardless of whether there's an exchange relationship. What they need to be mindful of is the country by country reporting notification form, right, which is due to be filed for 2021 financial year, for example, the last day of the financial year of the group, right? So I guess that answers the question that we have. So let's move on to the request for information. So in addition to the annual returns that are filed, right? So the tax authorities, in carrying out the IDR stage, the risk assessment stage of the audit, they would also require additional documents, right, to be submitted. So for those documents that are required to be submitted, how far back can the tax authorities go? Is the statute of limitation, respected by the tax authorities? That's one of the questions that we have.
Thanks so much. So the status of limitation is the provisions of the law. So FRS would have to abide by the provisions of the law. Though when audit requests, TP audit letters are being issued, at times the FRS, goes beyond 6 years. So it's for the taxpayer to notify the FRS of its right to limit the audit to 6 years as provided in the law. So ideally, the FRS can only request for information within the 6 years from the date the audit letter is being issued. So yes, the status of limitation also applies to transfer pricing audits. To then take it a step further, request for information depends on the tested party to the transaction. So for example, if the tested party is a Nigerian entity, majority of the information to prove the arm's length nature of the related party transaction will be from the local entity here in Nigeria. However, if the tested party to a particular transaction is a foreign entity, the FRS will typically request for financial and other records of the foreign entity. And this usually creates issues on field in the sense that, number one, the foreign entity is not subjected to the laws in Nigeria. So in some instances, we realize that a lot of multinationals would decline, and we typically look for alternative ways that the FRS can, justify or prove the arm's length nature of those transactions. So instead of releasing a financial statement, we can carve out an abridged statement that speaks to the specific transaction under review, and we can get a consultant, the offshore entity can get a consultant to sign off on those statements so that it will be acceptable to the FIS for use. So information could be requested from a Nigerian entity or a foreign entity, as the case may be.
Okay, all right. So the tax authorities do respect the statutes of limitation when it comes to audits,
yes,
and transfer pricing audits. And we have another very interesting question. Question goes: if there is an open audit, but it's open but dormant, say maybe the tax authorities have not communicated with the taxpayer for a certain period of time, but the audit had been opened covering the period 2013 to 2015 financial year. We're currently in 2021, right? But no communication has been had from the tax authorities concerning that audit. So after 6 years of commencement, should you assume, and of no communication from the tax authorities, should you assume that the tax audit, the TP audit, has been closed for the period?
It's a wonderful and at the same time a very, very technical question. Number one, we have to look at the position of the law. So number one, the audit has commenced and documents would have exchanged hands. And you can remember the reason why we have the status of limitation in place is the fact that there is the documents required for the audits may no longer be available. So that's why one of the reasons that we've limited audits to 6 years. But if audit has already commenced and documents have exchanged hands, the FIS can rely on those documents and resume the audit whenever they feel like. So I believe with the documents they have in hand, the FIS can still come back and proceed with the audits. And my advice would be that whatever outstanding support documents or additional documents that the company may have in-house, they should, keep it in a safe record and, retrieve it should the FIS come back to resume the transfer pricing audit. So that would be my response to the question.
So there's always the possibility that the tax authorities, once they've opened an audit, can come back and resume from wherever it is they left off. They could use available documents already to issue their first reports. And the tax payer, of course, would have to respond and ensure that the audit is closed out at whatever point the tax authority decide to resume the audit. So I guess this question sort of feeds into my next question, right? So how long from the commencement of an audit does the end usually happen? So how long does the audit process for transfer pricing usually take, right?
Okay, thanks for this. Before I answer that question, let me just add another additional point to my last response. The taxpayer can actually be proactive. They can actually approach the FIS and not wait indefinitely, particularly if the audit might be low risk and you won't know until you approach the FIS and follow up. So you can approach the FIS and request that they issue a clearance letter and you can move on. So back to the current question, TP audits in the past, 2014, 2015, when FIS started selecting few companies in the consumer industrial market space, we realized that TP audit lasted for about 18 months to 24 months. This was when the FIS were still, learning on the job. However, from 2016 upwards, they've actually invested in trainings They've also posted more officers to the transfer pricing division. They've also collaborated with tax authorities outside Nigeria, as well as subnational bodies such as the tax inspectors without borders. So they were able to, rub shoulders, exchange experiences, exchange their challenges. And what we see now is that depending on the company's ability to provide required information, the audit can actually be closed within 6 to 12 months or as low as 3 months. So if your transactions are not that complex and you're able to provide information, support documents to the FIRS, then you should be able to close your audit within 3 months. So if you look at the ideal stage, if you're able to provide information within a week, the FIRS is going to issue an invitation letter to make a technical presentation the following week. So once you make that, then the third week, the FIRS can come for a field visit. And field visit is just 5 days. So depending on the site, it could be 1 week or 2 weeks. But from experience, it's majorly 1 week. So that's about 3 weeks. Then if you respond to post-information requests after the field stage, the FIRS typically takes 2 weeks to issue their report. That's about 5 weeks, give or take. And once the FIRS issues their reports, they give you about a week or two to respond and come for a reconciliation meeting. So you can actually conclude your audit within 8 to 12 weeks. So it depends on your ability to provide, your level of responsiveness to their requests.
Okay. So what you've described is the ideal scenario, right? Ideally, right now, given the pace at which the tax authorities have been moving with TP audits, it's possible to close out the audits within 2 months if you are responsive as a taxpayer. So a lot of the responsibility for closure really lies with the taxpayer, right? And the taxpayer can always, if they're eager to close out an audit and move to an area of certainty from uncertainty, they can always, push for the audit to move a bit faster than its current pace if things were just left solely in the hands of the tax authorities. So right now, the good news is, if you are ready for an audit and the taxpayers approach you and you're able to practically provide all the information that's required, the audit process will typically move along very fast and you can get closure in a shorter period of time than used to be the norm, right? But where you're not prepared for a TP audit and the tax authorities request for information, of course, the request for information, what we've seen is the request for information for a period of 6 years, right? So the audits that are starting now would cover from say 2020, from 2015 financial year to probably 2020 financial year, and the tax authorities will be asking for all of that information at the go. So sometimes the slowness, would I say, of a TP audit is actually caused by the drag that comes with taxpayers collating all of the information that they require to submit to the tax authority. So that's why document retention, proactive document retention in preparation for a TP audit is very essential, so that the audit process does not drag longer than is necessary, right? So you mentioned a lot of things around, the intention of the tax authorities around the TP audits, right? You mentioned that they want to establish things like the existence of a TP audit, the benefit received, commercial rationality, and compliance. So how do you establish through the documents that you are retaining as a proactive taxpayer that the transaction exists and that you drew benefits, economic benefits from that transaction through the documents that you make available to the tax authorities?
Okay, thanks for that question. So if you check the definition of TP documentation in the OECD transfer pricing guidelines, it goes beyond preparing a report and explaining your transactions carrying out an economic analysis and concluding that those transactions are at arm's length. To prove existence, you need support documents. So if we take trainings, provision of trainings, for example, let's look at the engineering space. So you have your technical guys offshore providing maybe remote or on-site support to a Nigerian entity operating in the oil and gas services sector. So one of the ways you can prove existence is, number one, the physical presence of those guys in Nigeria. That's one of the ways you can prove existence. Then if those supports were provided remotely, you need to have email correspondence requesting and approving or allocating a particular engineer to provide the technical support. You need agreements, you need invoices, to support those transactions. So a proper TP documentation goes beyond just preparing the report. You need to, prepare other support documents that relates to that transactions. So those transactions rather. You also need to ensure that you keep appropriate records. So I would typically advise clients to have, separate ledgers for different types of transactions with different related entities, so that things are not muddled up. So when you're doing a reconciliation or trying to review those transactions, it will be easier to explain to the tax authority. So if the focus of the tax authority is on a particular transaction, the information you'll be giving to the tax authority would solely be based on that transaction, as opposed to information relating to other transactions that they are not looking at. So you need to have your agreements in place. You need to have invoices. You need to have records of interactions. At times, the FIS will typically request for board minutes for some transactions. So give us, board minutes for so year, confirming when decision was taken to engage this particular related party, or and those that made such decisions. So the FIS could request for any kind of documents for them to assess the arm's length nature of those transactions. So in your view, internally, any documents, any records that speaks to each of your transactions, you need to maintain them so that you'll be able to prove to the FIRS that you've done the right thing in terms of pricing your related party transactions.
Okay, thank you very much for emphasizing the importance of record keeping in and identifying the kinds of records taxpayers would need to have in place to establish existence and benefit. So it's 11 o'clock now, actually 1 minute past or 2 minutes past. We are supposed to have started our break at 11, but we'll start it now. So we'll take a 3-minute break to allow our facilitator, drink some water, refresh and regroup. And then we'll come back 3 minutes from now to take the next poll and your subsequent questions. So stay with us and please come back after the 3 minutes so that we can continue on this session. Thank you very much, everyone.
Learn on the go and stay informed. Our goal is to keep the average user informed and up to date with relevant tax information. For the entrepreneur and investor, getting acquainted with tax laws and regulations could be quite daunting. Well, not anymore. Introducing the KPMG Tax mobile app, where you can access all tax-related news, laws, and insights in one place. Also, calculating personal income taxes has never been quicker. To get the app, simply search for KPMG Nigeria Tax on Google Play Store or iOS Store and install. Once installed, Quickly do a one-time sign-up on the application to access a constantly updated library of news, laws, and articles alongside easy-to-use tools. The KPMG Tax mobile app has a minimalist design, making it effortless to use and navigate. What's more, if you can't find what you need, asking a professional is as fast as it gets. Let's walk you through the application. The full menu is accessible from the left and helps you jump to any part of the application in seconds. Access fresh tax news by clicking on the news icon. The seamless scroll makes it simple to view all news at a glance. You have news you've already seen and want to go back to, just search. Expand or share each news item to your friends with the dedicated buttons. Adjust your news preference easily from the settings icon and tailor your content. We have embedded tax legislation and popular cases in our tax laws section. Are you eager to know more about taxation in Nigeria? KPMG Tax app has more than enough for you. Stay on the cutting edge of industry updates with insights features. The new app brings together alerts, newsletters, articles and publications from industry-leading KPMG professionals. You don't have to worry about missing important regulatory dates and other notable events. The notable date feature brings them all into one place in a calendar or list, however you want to view them. For the average employee, entrepreneur or business person, KPMG Tax app has another important feature, the PIT calculator. Plug and play, simple as it gets. Input the required numbers and calculate your taxes. Also, the app has jokes and valuable tips. Check in to learn something new and fun. Still feel there's more to know? We've got your back. Ask an expert and get quick, insightful responses from KPMG professionals when in doubt. Learn more from various authorities through recommended links in the external links tab. Read all about us to find out more about KPMG's service offerings, our responsible tax principles, and disclaimer. It's now a breeze to connect with us online. Just click on the link icon on the homepage to get to us on social media. KPMG Tax app, connecting with you on the go.
Okay, welcome back, everyone. So we're going to start our next poll session now. I believe that, by now, those of us who joined early enough are already pros at connecting with the poll, but I would refresh those of us that joined a little later with the instructions on how to connect. So you can simply connect by scanning the barcode that you can see on your screen with your phone camera. So once you do that, you would see a link that you can click on that will take you directly to the poll questions, or you can enter the address that you can see on your screen, https://app.slido/events. And then once you enter that into your address bar, you can use the code #433742 to join the session. I believe a link to this second poll has already been dropped in the chat box. So you can also follow the link to be able to access this chat, this poll session rather. So we'll give a minute as usual for all our participants to join the poll. We're looking forward to you sharing your views on your experience with the TP audit. Yes, so the chat box now has a link to help every one of us to join the poll. So we'll give a minute. The barcode is still on the screen as well, and the PIN that you'd need to enter once you are on the page for the poll. Okay. Okay, we just have a handful of participants already on. For the rest of us, if you're having any challenges, please just, explain the challenge in the chat box so we can see how we can help. But I believe that the instructions are quite clear and it's pretty easy to join. So most of us wouldn't have any challenges joining, especially if you participated in the very first one. So the first question is already showing on the screen is your company currently undergoing a transfer pricing audit? Right? That's the very first question. Is your company currently undergoing a TP audit? Over nearly 70% of the respondents so far have indicated no. So it means that the FRS still has a long way to go in terms of covering taxpayers for audits, right? Or maybe you just might be within the lucky category that would have been classified as low risk. Who knows? Yeah, but this session will still be very useful to every one of us to make sure that for those of us undergoing an audit currently, we're ready and equipped to be able to manage the process. That's around 31% of the respondents so far. Only 3% have already concluded audits. That's interesting.
Yeah.
It's quite interesting, right? So we still have a long way to go in terms of closure of audits. Okay. All right, and it will be interesting to hear from those of us who have already concluded audits, how the conclusion was, if it was favorable, something that aligned with your expectations, or yeah, it will be interesting to hear that. Okay, so I think now it's quite clear, around 70% of the respondents haven't undergone a TP audit, roughly 30% are currently undergoing one, and only 2% have already concluded audits. All right, so for those of us currently undergoing audits, and for those of us who haven't yet undergone one, this session will be very important for you to take note of the things you can do to make sure that the outcome of the audit is favorable. And for those of us who have already concluded audits, the lessons that you have drawn from the audits that have already been concluded and the insights you're going to gain from this session, you can use it to proactively prepare for the next audits that could happen in the future. Okay, so the next question, what stage is your company in the TP audit process? So for the 30% or so of us who are currently undergoing an audit, it will be good to see at what stage you currently are with the audits. Okay, so the majority seem to still be at the early stages with the information and document requests. Around 13%, or rather 20% of us are at the reconciliation and dispute resolution stage. So your pathway is almost 70% done with the audit process at this stage. Okay, interesting. All right. Gali, any surprises from the responses?
Well, I would imagine maybe because of the number of companies that are selected for audits. So I'm not surprised that a lot has not progressed to the field stage. So,
yeah.
There's so much the FRS can do, even though they've increased the number of staff being deployed to the International Tax Division and TP specifically. There's still so much they can do with their current capacity. So what I'm thinking is probably the audits that have commenced maybe in 2019, early 2020 might reach the final stage, while the audits in the IDR stage will then be recently issued audit letters, probably late last year or early this year.
Yeah, that's true. So in the coming year, we'll see a lot more audits moving from the IDR stage to probably the field stage and hopefully closure within 2022 calendar year. All right, so we can move on to the next question now. For companies that have been audited, how did you find the experience? Was it a walk in the park? Very challenging? Or are you indifferent?
Wow.
Okay, no surprises there. I would be shocked if anyone describes it as a walk in the park. If you do, then I mean, I'm going to maybe at a subsequent session cede the floor to you to explain how you manage the process to ensure that it was simply a walk in the park for you, right? So we have a 50-50 split. A few of 50% are saying that they found it, oh, okay, well, very challenging is now in the lead. Around 55% of the people who have completed and who have been audited found it very challenging. No surprises there, because that would most definitely have been your very first transfer pricing audit as an organization. So there would have been a lot of gray areas to navigate, a lot of things that you may not have been aware of prior, that you would have just been discovering during that audit. So yeah, so 62%, over half of us are saying, they experienced significant challenges. So hopefully this session, will provide enough insights to make sure that your next audit would not be challenging. It's always challenging, but as challenging as your last one. And then we're always here, the transfer pricing team of KPMG, to offer assistance, hold your hand through the process, so that hopefully subsequently you'll be able to describe it as a walk in the park that you took with us. Yeah. Okay, so we can go to the next question now, right? Okay, this is something I'm very interested in seeing the outcome of. Will you consider a court resolution for TP audit disputes? Wow. 67% are saying, a whooping 67%. Oh, 75 now are saying yes, right? Okay, swinging, but the majority are saying yes. Okay, the majority have indicated yes. Let's see more answers come in so that we can, know what it is that taxpayers are leaning towards when it comes to resolving these audits. Okay, Gali, surprised at the response so far, or is it what you expected?
To be honest, I'm quite surprised, because it's only one case that has been taken to the TAT.
Yeah.
In TP. So I'm quite surprised by people's response. But I guess for you to be confident to approach the TAT for a ruling, that means you have no doubts in the arm's length nature of the pricing of related party transactions, and you also have relevant support documents in place to defend those transactions. So, and that's it really. Once you are comfortable with the pricing of your transaction and you have documents to prove beyond doubt. Now, I'm not saying reasonable doubt, to prove beyond doubt, because the FRS doubts may not be reasonable at times. So if you have documents to support your transaction, why not? So you can approach to the TAT to get a ruling. Now, the fear or my challenge is, and we've seen this in other clients. So I'm not saying the judges are not competent, but TP is relatively new, and you need somebody to really understand those transactions, and to really understand that TP at times is not all about the profitability of the local entity. It's about what is obtainable in the marketplace. And the risk from a Nigerian perspective, number one, is our economy. So the Naira is being devalued by the day. So ordinarily, if you pay for services in foreign currency, the impact on your P&L will be huge compared to let's say 2012, 2013, when the Naira was exchanging for about 215 to a dollar or 230 to a dollar. So if you keep incurring similar expenses in 2020, that's about double the amounts that you'll be recognizing in your financial statements. So outside the, pricing of those transactions, there are other economic factors that affect the performance of Nigerian companies. So trying to explain all these qualitative arguments to the judges is key, and then reasoning with you and accepting those arguments, it's another thing. So it's just disappointing that the basis of dispute in the first TP case wasn't wasn't really clear, because the FRS approach was not adequately challenged at the TAT. Then too, the point of ruling was on the inconsistency of the taxpayer in applying a particular TP method. So we've not really seen the court delve into transfer pricing technicalities in sufficient details for us to assess their level of understanding and competence in that area.
Yeah. Well, I guess with time, especially judging by the responses that we've gotten around the number of people who would consider a court resolution, we probably would have a lot more decided cases that we can refer to, and that would point to the competence of the judges when it comes to closing out TP audits, so reasonably, right? So for now, we just have one decided case to rely on, and well, there are lots more to look forward to in the pipeline, going by the responses that we have and the number of open TP audits that we have, right? So we have a last question, I believe. In a few words, give your opinion on the likely impact a TP audit may have on your business operations. So this is open-ended. Feel free to express yourself in whatever words capture your opinion succinctly. So. Okay, I've not seen any answers come through yet. This is open-ended, so I guess maybe you'd need a few minutes to think about, or a minute or so to think about what words. Disruptive. Okay. It has the potential to change everything, right? Demanding use of management time. Yeah. Demanding use of management time. Disruptive in the sense that the outcome of that audit would mean that you may have to sit down and take a second look at the way that you have structured your related party transactions and whether or not it's sustainable, depending on the outcome of the audit. Demanding use of management time, definitely. During the field stage of the audit, personnel outside of the finance function would also need to devote significant time to making sure that that they're present to respond to whatever questions the tax authorities would ask on field. And then, of course, management and the finance function would be very invested in managing the outcome of those audits. Need to restructure, definitely. It may lead to or expose a need to restructure existing intercompany arrangements. An additional problem for the tax function, because decision makers will still make decisions based on business case and not tax. You cannot help that, really, right, Gali?
And I think it's a very, very valid point.
Very valid, yeah. So you can't really help that. Businesses would always take decisions based on business case, and tax may be, the afterthoughts at the end of the day. So it's really true. The penalties at the end of the audit might affect the cash flow. Yes. So TP audits, the liabilities resulting could run into billions, right? Especially because the audits usually cover a period of about 6 years. So just imagine making adjustments to transactions that are running into billions for a period of 6 years. The outcome could significantly impact the cash flows of the business. taking a second look at the TP policy. This FRS will always be FRS. They need to take advantage of the system.
Yeah.
Right. Witch hunting. Okay, this is an interesting accusation, right?
Yeah.
Okay. It may change our current operational model, which has a lot of related party transactions depending on the outcome of the audit. So one thing is clear from all of the responses we've seen so far. The outcome of an audit would most likely lead to an update of the existing structures when it comes to related party transactions. The first audit that you're going to undergo would require lots of investment of management time, significant investment, because management will be interested in ensuring that the outcome does not erode the cash flow position of the company in such a manner that the company would have to stagger to continue in business. So thank you very much for being expressive, sharing with us your views on the TP audit's likely impact on your business operations. I think that's the very last question that we have, right? So we can move on to the questions in the chat box. We have quite a few questions in the chat box already. So the first question, interestingly, I think we sort of answered this in a way, is how many transfer pricing audits have led to court cases, right?
It's only one, and it's the Prime Plastic Chem Nigeria Limited case with the FRS, and the TAT ruled in favor of the FRS, and this led to an exposure of about 1.74 billion naira. And the crux of the case was that the FRS had to change the approach the taxpayer used in demonstrating compliance with the arm's length principle. So the taxpayer was engaged in the importation and sale of petrochemical products, and in some years they've used the comparable uncontrolled price methods to price the transaction. Now, what the CUP method means is that the Nigerian entity is relying on the price at which their foreign counterparts sold those petrochemical products to third parties. And the comparability requirements for a comparable uncontrolled price method is tedious. So you need a lot of invoices. You need to explain how you arrive at discounts, where discount has been granted to a related party or a third party as opposed to a related party. So the taxpayer was unable to prove beyond reasonable doubt the arm's length nature using the CUP method. Then in other years, the taxpayer used the transactional net margin method, wherein they check the operating margin of the company. And in those years, they made losses. So the FIS stuck with the transactional net margin method. However, use the gross margin, which is something that is technically incorrect. So gross margins are applied at the gross margin level and not at the TNMM level, which is the operating margin. So the PLI, the appropriate PLI for the TNMM is the operating margin as opposed to the gross margin. So those were the loopholes in the FIS's approach, which the taxpayer could not point out clearly at the TAT. So unfortunately, the ruling was in favor of the FRS. So that's about the only decided cases for transfer pricing.
Okay, so yes, that's right. We just have one decided case, and although it left a lot to be desired, right, it still highlights the importance of taxpayers being ready, especially when you have a procurement transaction. So it's still something that points to the thought processes of the tax authorities around procurement transactions, which I'm sure a number of companies in Nigeria actually have. So, and it shows you how, if you're currently undergoing an audit, you can put together sufficient documentation to be able to defend your procurement arrangements and hopefully have a better outcome than this taxpayer did when it comes to closing out your audits. And if you have to escalate to the courts, having the courts decide in your favor when it comes to the audit. So there are lots of learning points, although, you know, like I said, the case did leave a lot to be desired, especially for those of us practicing and who are aware of the technical aspects of the case. All right, so the next question is, what kind of industries are covered under TP audits? Is this applicable for multi-site manufacturing industries and multi-country locations only?
Okay, so audit covers all industries: financial services industry, consumer and industrial markets, telecoms, energy and natural resources, all companies. So the choice to select a particular company for audit is triggered by the nature of the transactions being conducted, the profitability of the local entity, what was it called? The tax regime that the transacting entities have. So if you have one of the transacting entity in a pioneer status and you have the other entity paying tax under the CIT Act, so it could be a trigger for transfer pricing audits. Cross-border transactions as well. Then the nature of the transaction, like we mentioned, the last case involved a procurement arrangement. Then you also make payments for use of intangible assets. So those are the, audit triggers. So audit is not limited to a particular industry. So it depends on the FRS's assessment of the risk profile of the company in question.
Okay, all right. So I think your question has also answered the next question. It's clear that transfer pricing audits do cut across every industry, right? So it's not industry specific, as long as you have related party transactions and the outcome of the FRS risk assessment points to the fact that you're eligible to be audited. You would be audited whether you're in the financial services industry or you're a manufacturing company or you're a services-based company, whatever it is, or you're in oil and gas, whatever sector, it cuts across every industry. Although I think at the beginning, the tax authorities when they were trying to develop competencies with respect to audits, they had a focus on fast-moving consumer goods first before they now move on to companies in the oil and gas space. And I guess as they continue to build competency, they would also move subsequently to the other sectors, but it's not sector specific. So yeah. So we now have another question. A company that is a subsidiary of the holding company that is in Nigeria, is it the subsidiary of the holding company that should file TP? Is that clear or should I repeat it?
No, I think it's clear. So it's clear. So the obligation to comply with the tax and transfer pricing laws in Nigeria lies with entities that are taxable in Nigeria. So the subsidiary would have to comply. The local subsidiary in Nigeria would have to comply with the tax and transfer pricing regulations. Then the holding company will only need to comply with tax and transfer pricing regulations in Nigeria if it has a taxable presence in Nigeria, be it by having maybe a fixed base in Nigeria based on the Company Income Tax Act, or based on the DTT, Article 5 of the DTT on permanent establishment, or through significant economic presence order. So those are the three scenarios where a non-resident company will be deemed to have a tax compliance obligation in Nigeria. So subsidiaries a Nigerian society would have to comply, but a foreign entity would have to have a taxable presence in Nigeria to comply with the tax and TP laws in Nigeria.
Okay, all right. So that's very clear. You need to have a taxable presence in Nigeria to be able to come under the purview of the Nigeria transfer pricing regulations and be required to file TP returns, right? So where there is a subsidiary in Nigeria, the subsidiary will be required to file, and the holdco would only come under the purview of Nigerian taxes if it's deemed to have a taxable presence in Nigeria. So the next is, what is the requirement to have a contemporaneous report? I think maybe the confusion here would be that, you know, contemporaneous report has different names by which it is referred to. So what is the requirement to have these contemporaneous reports? And is there an amount of threshold for this to be in place?
Okay, so unlike the 2012 regulations, the 2018 introduced the 300 million naira threshold to maintain a contemporaneous transfer pricing documentation. So if you aggregate your related party transaction, the total value is less than 300 million. So such taxpayer may choose not to maintain a contemporaneous TP documentation. However, the provisions of the law, so there is no absolute exemption. So the FIRS can still, you know, come back and request that the taxpayer furnish it with the contemporaneous TP documentation. And in that instance, such taxpayer would have 90 days to prepare and submit the TP documentation to the tax authorities. So my advice would be that once you engage in related party transactions, all support documents to justify, to demonstrate compliance with the arm's length principle should be kept intact, such that if the FIS requests such entities to submit the documentation, they would have support documents to, you know, to prepare a robust TP documentation that would, you know, adequately demonstrate compliance with the arm's length principle.
Okay, so there is no absolute exemption, right?
Yes.
The threshold says 300 million. You need to have the regulations say that once you have transactions in excess of 300 million, you need to have your documentation in place by the due date of your filing, even though you're not going to file that documentation until the tax authorities request for it. Thereafter, you have 21 days to submit it. And then if you have total control transactions less than 300 million, you have 90 days to make it available when the tax authorities request for it. So there's no absolute exemption. You would still need to maintain contemporaneous TP documentation, or what is called the TP local file, right? Yeah. Along with, all your other supporting documents that the tax authorities are likely to request for. Our next question is quite specific to a transaction, right? And it's a very interesting question. So it's specific to intangibles arrangements. And the question goes, in line with Regulation 7 of the 2018 Transfer Pricing Regulations, the amount payable for transfer of rights in an intangible should not exceed 5% of EBITDA. So based on this cap, are companies still expected to perform a benchmarking analysis on a similar transaction, considering the fact that there is an existing cap already, right? So,
okay, I think it's a very interesting question. So, my short response would be that for all the requirement of the law is that you should demonstrate compliance with the arm's length principle. So you need to prepare a benchmark to support payments for intangible transactions. And we've seen in practice that payments for intangible transaction in some instances may be lower than the 5% of EBITDA. So even the restrictions would not apply. Then for clients that would like to challenge the jurisdictions of the FRS to limit payments for use of intangible assets, will then need to prepare a documentation to support their own pricing arrangements and be able to take the case to the TAT. So the basis for challenging the FRS is that even though the Finance Act has said for a related party expense to be deductible, it must comply with the TP regulations. Based on decided cases and the court rulings, the legislature cannot, give the tax authorities the right to legislate on some matters that are exclusively within the purview of the legislator. So if you look at the Company Income Tax Act, the requirements for an expense to be deductible is for it to pass the rent test. And the Company Income Tax Act is an act of the National Assembly. So even though the Finance Act requires that related party expenses should comply with the TP regulations, then the regulations should not go beyond what it's meant to achieve. So, and if you look at the FRS Establishment Act, regulations are meant to assist the FRS to implement, the Principal Act. So if you take artificial transaction provisions in the CIT, for example, and that was one of the reasons why we had the TP regulations in place in the first instance, so that for artificial transactions that are deemed to be artificial in nature, the FRS would not make arbitrary adjustments. So there should be a systematic approach to adjusting the pricing of related party transactions, which is why we have the TP regulations in place. Now, at the beginning of the regulation, you'll see that the objective is to establish the arm's length principle. So there is a contradiction here, even though Regulation 75 said notwithstanding any other provisions, still that regulation is beyond, having that restriction in place, in my own opinion, is beyond what the powers that FRS have under the FRS, I think Section 61 of the FRS Establishment Act. So taxpayers can actually challenge the provisions at the TAT and later in case the TAT does not rule in favor of the taxpayer. So, but you need to have a TP benchmark that supports your pricing of intangible transactions in place before you are able to then challenge the FRS. Though in practice, we've not seen any case going to the TAT on intangible transactions. And it will be interesting to know what the TAT judgment would be.
Okay, thank you very much. So that means, the taxpayer who faces this kind of scenario where you have intangibles transactions, maybe you go ahead and do a benchmarking analysis. The benchmarking analysis shows that for your particular arrangements, you can actually charge something higher than the limit of 5% of EBITDA. And you go ahead to align with the benchmarking analysis. You can still challenge the decision of the regulations in court if you are so inclined or you have the risk appetite to do that, right? So that's the response to, because there's a follow-up question and it says, if yes, what if the benchmarking analysis shows that the payment exceeds 5%? Is the entity expected to limit it to 5% or use the rate arrived at in the benchmarking analysis? So the answer really is, it depends on your risk appetite, right? Yeah. As an organization, based on Gali's response. So that would also inform how you would approach this scenario in the event of a TP audit, because during a TP audit, it's clear what the tax authorities would do, right? They would seek to align with the regulations, the provisions of the regulations concerning this transaction. So you already are well upfront that if you do anything contrary to what the regulations say around the pricing of these intangible arrangements, you need to be ready to defend it, because the tax authorities would not agree to go with your position, right? Even though it's defended or is supported by your benchmarking study. So the next question is also transaction specific. I like this question. It, points to one of the risk areas when it comes to transfer pricing in Nigeria. And it says, looking at the OECD guidelines under low value adding services, can the rate of the simplified approach be relied upon without performing any further benchmarking analysis? So this is where a company receives low value adding intragroup services from a related party, or a Nigerian company provides such services to its foreign related party. Would the simplified approach, can it be relied upon without performing any further benchmarking analysis for such a transaction?
Okay, it's also an interesting question. So, even though the Nigerian regulations adopts the recommendation of the BEPS Action 13 report issued by the OECD, the 5%, should I say, safe harbor rules wasn't specifically adopted. However, there are other sections in the Nigerian TIP regulations that allows taxpayers to rely on the OECD TP guidelines as well as the UN TP practical manual. And in practice, and based on our interactions with the tax authorities, they are not indisposed to taxpayers relying on the 5% markup for routine services as prescribed in the OECD TP guidelines. So even though the law, the TP regulation does not specifically adopt that provision, in practice, few clients have relied on the OECD guidelines in that regard. So to just simply apply 5% markup without doing any benchmarking analysis. And for them to do that is quite reasonable, because if you eventually carry out the benchmarking analysis, and based on our experience, you realize that the 5% would always fall within the interquartile range. So for OECD to recommend the 5%, it's based on experience, it's based on what they've seen across different jurisdictions. So taxpayers should be fine with the 5% markup for low value adding services.
Okay, so it's interesting to note that although Nigeria has not adopted the OECD simplified approach yet, once we do benchmarking analysis for actual low value adding intragroup services, the range that usually comes up is not aligns with the 5%, right? So if companies choose to do 5% without a benchmarking, chances are during an audit, if the tax authorities insist that the benchmarking be performed for that transaction, the results that we would get from the benchmarking analysis would align with the simplified approach if it was adopted, right? So our next question, right, is around the FRS's field visits, right? So you had mentioned that after the information and document request stage of the audit, the tax authorities may request that taxpayers come and make a presentation to the tax authorities in their office on their business operating model and other areas of their business. And thereafter, they usually go for a field visit, right? So during that field visit, do the tax authorities usually visit different phases of an entity where they exist in multiple locations? Or is it just limited to one?
Okay, thanks for the question. The FIS actually, the decision to visit the base, operational base, will be based on the transaction they are looking at and how important that visit is to their understanding and analysis of each transaction. So from my experience, the FI, especially if what they do at each of the base is not different, they may decide to just visit one of the base. But where you have different bases for different transactions, then there's a likelihood that the FIS would visit each of the bases to understand what is being done at the base, to understand what the site operators, what they do on a day-to-day basis. So yes, the FIS can visit multiple bases of a particular taxpayer.
Okay, and it's all boils down to the fact that the need for a field visit is for the tax authorities to be able to see in practice what you really do and align the substance of the transactions with the form that you have presented in your documentation and in your agreements that you have submitted so far. So where they feel like there's a need for them to visit multiple bases in order to come to a full understanding of how your business is carried out in practice, they may go an extra step to visit multiple locations to be able to get a full picture and to avoid assumptions when they are coming up with the audit reports. So the next question is, can the TP audit overlap to other aspects of tax? We had previously said that the TP audit focus is a little bit more narrow than other audits or regular companies income tax audit. The focus is on transfer price or on intercompany transactions. But is there a possibility that the TP audit can overlap to other aspects of tax?
Okay. I think I tried to mention this at my intro. So TP is not a new tax on its own. However, it covers all other areas. For example, if a related entity in Nigeria disposes of a property to another related entity within or outside the country, for example, CGT will apply. So the FIS will be interested in knowing whether you've disposed of that property at the market value, because 10% would apply on the chargeable gains. So yes, in the course of transfer pricing audits, you could see the FIS assessing the taxpayer to different types of taxes, except personal income tax. Now, for regular TP audits, based on our experience, there are instances where in the course of reviewing taxpayers' records, the FIS can notify other counterparts in other divisions of the need to actually look at the matter. And we also realize that the staff at the International Tax Department also have the competence to then look into other issues outside TP. So they can look at applicability of VAT on services provided by an offshore company. So during the course of their visit. Also, if the FIS take the view that there will be significant TP adjustments to the transactions they are looking at, they can actually write to, let's say, for example, special tax audit unit to stop, let's say, a refund audit, for example, and we've seen this in practice. So the FIS will write to their counterparts to hold on the refund audits for them to conclude TP audits, to be sure that the money they want to pay to the taxpayer, whether they need to, net it against the potential tax liability from the TP audits they are conducting. So TP audit could actually have implications for other types of tax audits that the taxpayer may be going through.
Okay, interesting to note. So yeah, transfer pricing is not isolated from the other taxes, so there could be overlaps, right, during an audit. Yeah. So yeah, thanks a lot for that response. And then so at the end of everything, we've come to the end of the audit process. We've gone through the field stage of the audit. We have gotten our audit reports. responded to the tax authorities, objected where where there is a need to object. We have discussed and agreed, the liability, and we've come to a consensus position with the tax authorities. So after, we have agreed to the additional liabilities. Does the FIRS typically accept payments in installments, or how does? Because companies have that concern around cash flow management. So would the tax authorities accept payments in installments in practice to manage this?
Okay. Challenge? Well, there is no express provision in the regulations that allows that, but based on our experience, the FIRS typically allows taxpayers to pay the liability in equal installments, maybe within 3 months or 6 months. So we've seen it in practice.
Okay, so that's really good news for those taxpayers who have a concern around the impact of the resulting liability on their cash flow position. You still have an option to manage it and make sure that the impact is not so upsetting for your business, right? By applying to pay in installments. Okay, the tax authorities are open to considering such requests for payments in installments. Okay, so next question is, do additional liabilities arising from the audit, whether it be companies' income tax, withholding tax, or value-added tax, does it attract interest and penalties, or?
Yeah, it's an interesting question. I think that there's a decided case on that. So once the liability is final and conclusive, and the taxpayer does not pay within the agreed period, maybe let's say 30 days, then interest and penalties may apply. So but we have a special arrangement with the tax authorities to spread the payments across maybe a period of 6 months, then interest and penalties should not apply. But beyond that period, the FIRS can then decide to apply interest and penalties. So once the liability is final and conclusive, and the FIRS, the taxpayer does not pay within 30 days or within an agreed period with the FIRS, the interest and penalties can then apply.
Okay. Okay, so I guess that's also encouraging for those people who are considering, who have already done their risk assessment and seen that, oh, we're likely to have CIT arise or withholding tax or VAT upon conclusion of this audit. At what point should we start factoring in interest and penalties? So we're almost at the top of the hour, 12 noon, when we're supposed to be rounding up. So in conclusion, I would ask the final question, and in a nutshell, what advice would you give to a taxpayer who is about to be audited, or taxpayers who are currently being audited, to ensure that the outcome of the audit is something that aligns with their expectations, right? So what advice would you give in a nutshell to a taxpayer in that situation?
Okay, having a diagnostic review of your compliance with TP at least 6 years backwards will be a good way to start. So for regular tax audits, taxpayers usually they conduct a pre-audit. So they ask a consultant to come and review their books and records, and where they've not, where there is a shortfall, they quickly make payments and avoid the tax authorities making the adjustments themselves. So we can always conduct TP health checks to see that we've appropriately analyzed our related party transactions, to see that we have appropriate documents in place to support the arm's length nature of our transactions. So these activities can be carried out before year-end closure. So you can make those adjustments and you can have them impact your financial statements before they are finalized and approved for signature. So that's the advice really. So taxpayers need to be they need to be proactive. They need to be proactive. They need to be sure that you've done the right thing before the FIRS comes to the field.
Yeah. So taxpayers are encouraged to adopt a proactive stance rather than simply wait and be reactive when the audit starts, because once the audit starts and you're not ready, you're less likely to have an outcome that you'd be happy with at the end of the day, especially because with transfer pricing, there's a lot of emphasis on your ability to defend the arm's length nature of your transaction using available documents and information, right? Ensuring that your TP documentation aligns with what you do in practice. So there's a lot, that's really the advice. Be as proactive as possible. Engage in your tax consultants to do a transfer pricing health check. Make sure you have all your documentation in place. Submit all your tax TP returns as at when due, so that you don't, apart from the liabilities arising from a potential audit, you are also able to avoid the penalties for acts of non-compliance, which could also be really significant, right? So that is really the advice. Thank you so much, everyone, for your time. We really appreciate taking the time out to be with us today and your active participation on today's session. We really, really do appreciate that. And yes, we are always available to keep the conversation going. So if for any reason, we have missed out on responding to your questions, feel free to connect with Gali Aka on LinkedIn and direct your questions to him, or reach out to any of your other KPMG contact people. We're always ever ready to provide support to our clients, answer the questions, and of course, hold your hand through the process, right? We're always there to help you out. So feel free to reach out to us. We also encourage you to download the KPMG mobile tax app. That is also another avenue via which you could ask your questions if you have any, and interact with the KPMG team so that you're a proactive taxpayer at the end of the day, and you are happy with whatever tax outcomes you have when it comes to these matters. We look forward to connecting with you again during our very next tax chat. I believe the details of which would be publicized via the usual channels. And if you receive a communication from us, we'll definitely reach out, letting you know when the next tax chat would be holding. So thank you so much, and do have a wonderful afternoon and rest of the week, everybody. Thank you very much, Gali, as well, our able facilitator for today. Thanks a lot for the insightful session that we have had. So do have a great day, everyone, and bye. Yeah.
Learn on the go and stay informed. Our goal is to keep the average user informed and up to date with relevant tax information. For the entrepreneur and investor, getting acquainted with tax laws and regulations could be quite daunting. Well, not anymore. Introducing the KPMG Tax mobile app, where you can access all tax-related news, laws, and insights in one place. Also, calculating personal income taxes has never been quicker. To get the app, simply search for KPMG Nigeria Tax on Google Play Store or iOS Store and install. Once installed, quickly do a one-time sign-up on the application to access a constantly updated library of news, laws, and articles alongside easy-to-use tools. The KPMG Tax mobile app has a minimalist design, making it effortless to use and navigate. What's more, if you can't find what you need, asking a professional is as fast as it gets. Let's walk you through the application. The full menu is accessible from the left and helps you jump to any part of the application in seconds. Access fresh tax news by clicking on the news icon. The seamless scroll makes it simple to view all news at a glance. You have news you've already seen and want to go back to. Yes. Our goal is to keep the average user informed and up to date with relevant tax information. For the entrepreneur and investor, getting acquainted with tax laws and regulations could be quite daunting. Well, not anymore. Introducing the KPMG Tax mobile app, where you can access all tax-related news, laws, and insights in one place. Also, calculating personal income taxes has never been quicker. To get the app, simply search for KPMG Nigeria Tax on Google Play Store or iOS Store and install. Once installed, quickly do a one-time sign-up on the application to access a constantly updated library of news, laws, and articles alongside easy-to-use tools. The KPMG Tax mobile app has a minimalist design, making it effortless to use and navigate. What's more, if you can't find what you need, asking a professional is as fast as it gets. Let's walk you through the application. The full menu is accessible from the left and helps you jump to any part of the application in seconds. Access fresh tax news by clicking on the news icon. The seamless scroll makes it simple to view all news at a glance. You have news you've already seen and want to go back to? Just search. Expand or share each news item to your friends with the dedicated buttons. Adjust your news preference easily from the settings icon and tailor your content. We have embedded tax legislation and popular cases in our tax laws section. Are you eager to know more about taxation in Nigeria? KPMG Tax app has more than enough for you. Stay on the cutting edge of industry updates with insights features. The new app brings together alerts, newsletters, articles, and publications from industry-leading KPMG professionals. You don't have to worry about missing important regulatory dates and other notable events. The notable date feature brings them all into one place in a calendar or list, however you want to view them. For the average employee, entrepreneur, or business person, KPMG Tax app has another important feature, the PIT calculator. Plug and play, simple as it gets. Input the required numbers and calculate your taxes. Also, the app has jokes and valuable tips. Check in to learn something new and fun. Still feel there's more to know? We've got your back. Ask an expert and get quick, insightful responses from KPMG professionals when in doubt. Learn more from various authorities through recommended links in the external links tab. Read all about us to find out more about KPMG's service offerings.